Brother, today we are going to go deeper than we have ever gone before. We are going to talk about artificial intelligence not as a concept but as a practical operational tool. We are going to talk about tax architecture not as an accountant's concern but as one of the most powerful wealth-building levers available to any ordinary person. And we are going to talk about why most people who do everything right still arrive at retirement with significantly less than they should have. And the answer to that last question is the thread that connects everything we are going to discuss today. So let us begin at the very beginning, because I want to make sure that everyone watching this, regardless of their background, whether they have been investing for 20 days or 20 years, can follow every single word of what I am about to say. When you build a portfolio, you're essentially building a machine, and like any machine, it has three layers that determine whether it performs well over time. The first layer is what the machine is made of, meaning the assets inside the portfolio, the index funds, the precious metals, the REITs, everything we have discussed in previous videos. The second layer is how the machine operates, meaning the automation, the rebalancing, the systematic contributions, the rules that run the machine without requiring you to be present at every moment. And the third layer, the layer almost nobody talks about, is how intelligently the machine adapts to its environment, because the environment changes, tax laws change, market correlations change, currency dynamics change, inflation regimes change, and a machine that was perfectly calibrated for one environment can slowly become misaligned with a different one without anyone noticing, and this is where the intelligence layer becomes not a luxury but a necessity, and that is why artificial intelligence enters the conversation as infrastructure. Now let me explain what artificial intelligence actually does in a portfolio context in the simplest possible terms, because this is genuinely misunderstood by almost everyone, and the misunderstanding goes in two directions. Some people think AI in investing means a robot that predicts the future and tells you which stock to buy before it goes up. Forget them. Nobody can predict the future consistently. Not algorithms, not analysts, not supercomputers, not anyone. And any platform or person claiming otherwise is selling you something expensive and delivering something worthless. The other misunderstanding is that AI in investing is just marketing language slapped onto ordinary tools to make them sound more impressive than they are. And while this is sometimes true, it is not always true, because there are specific, concrete, measurable functions that machine learning performs better than human oversight, and those functions matter enormously over long-time horizons. Let me tell you what those functions actually are. The first function is drift detection. When you build a portfolio with a target allocation, say 50% global equities, 20% precious metals, 30% fixed income, and REITs, that allocation begins to drift the moment markets open. Equities go up more than expected. Suddenly you are holding 57% equities without having bought a single additional share. Precious metals decline, suddenly your inflation shield is smaller than you designed it to be. Over months and years, this drift accumulates silently, and the portfolio you are actually holding becomes meaningfully different from the portfolio you intended to hold. And the risk profile of your actual portfolio may be completely different from the risk profile you are comfortable with. You would never know unless someone or something was watching continuously. A human being cannot watch a portfolio continuously without it becoming a second job and a source of constant emotional interference. An automated system can watch continuously without emotion, without fatigue, without the temptation to interpret drift as a signal to do something dramatic. And when drift exceeds a predetermined threshold, the system rebalances back to target, not because a human decided it was time, but because the rules you loaded into it decided, and rules made in advance when you are calm are almost always better than decisions made in moments when you are not. The second function is tax loss harvesting, and I want to spend real time on this because it is the most misunderstood and most underutilized tool available to individual investors. Let me explain it from the ground up. When you hold an investment and its value declines below what you paid for it, you have what is called an unrealized loss. Most people experience this as pure pain, as something to be endured, or worse, as a trigger for panic selling. But within a properly structured system, this unrealized loss is actually an asset, a tax asset, because if you sell that position, you realize the loss, and that realized loss can be used to offset realized gains elsewhere in your portfolio, reducing the taxes you owe, and then immediately you purchase a different but correlated asset that maintains your intended market exposure, so your portfolio continues to participate in market recovery while you have harvested a tax benefit that will reduce your bill at the end of the year. Done manually, this requires constant attention, precise timing, and a thorough understanding of tax rules, including the wash sale rule in America, which prohibits repurchasing the same security within 30 days of harvesting a loss. Done automatically by a platform with machine learning capability, this happens continuously, systematically, and in compliance with all relevant rules, and the accumulated benefit over decades is not trivial. Research from multiple independent sources suggests that systematic tax loss harvesting can add between 0.5% and 1.5% to annual after-tax returns in volatile market environments. And brother, I want you to understand what 0.5% compounding over 30 years on a growing portfolio means. I want you to actually feel that number, because 0.5% looks like the kind of difference you round away. It looks like noise. But on a portfolio that grows from 50,000 to 500,000, the additional 0.5% annually in after-tax return is not noise. It is close to 100,000 additional dollars sitting in your account that would not have been there otherwise, earned not by taking more risk, not by finding a better stock picker, but purely by executing a legal, systematic, rules-based strategy more efficiently than a human brain could execute it manually. The third function of the intelligence layer is anomaly detection, and this is perhaps its most underappreciated aspect. A well-designed monitoring system does not just track your portfolio, it tracks the relationships between the components of your portfolio and flags when those relationships change in ways that suggest your assumptions need revisiting. For example, there are periods in market history when assets that normally move in different directions begin moving together. When the diversification you thought you had stops working because correlations between asset classes shift, and this happens. It happens during liquidity crises, it happens during certain inflation regimes, it happens during geopolitical shocks, and when it happens, the portfolio that felt safe suddenly feels very different. A monitoring layer that tracks these correlations and alerts you when they shift meaningfully gives you information that is genuinely valuable, not to trigger panic, not to prompt dramatic restructuring, but to allow informed, calm, deliberate assessment of whether the system needs adjustment. And the keyword there is calm, because information received through a structured system feels different from information received through financial news. One is data delivered to a decision-making framework, the other is noise delivered directly to your nervous system, and your nervous system is not a good portfolio manager. Now let us talk about platforms specifically, because specificity is respect for your time. In America, Wealthfront and Betterment have built automated tax loss harvesting and rebalancing directly into their account infrastructure, meaning from the moment you fund your account, these functions are running continuously without any action required on your part. M1. Finance allows you to build custom portfolio allocations and automates rebalancing around your contribution schedule. Fidelity and Vanguard have introduced automated rebalancing features within their account structures. These are not perfect platforms, and I am not endorsing any single one of them unreservedly, but they represent the practical application of the intelligence layer to the individual investor's actual life. And the question is not whether they are perfect. The question is whether they execute a systematic strategy better than an emotionally available human being checking their portfolio at unpredictable intervals. And the answer to that question is almost always yes. In Turkey, the infrastructure is different, but the principle is identical, and the opportunity is significant and deeply underutilized. The BES system, the individual pension system, is perhaps the most structurally advantageous savings vehicle available to Turkish investors. And it is treated by most people as an afterthought, as something they signed up for at their employer's suggestion and have not thought about since. And this is a serious mistake, brother, because the state contribution mechanism built into BES functions as an immediate guaranteed return before a single investment decision is made, before a single market moves in any direction, before any compounding begins, and I want to make this completely concrete so there is no ambiguity. When you contribute to a BES account, the government adds a matching contribution on top of yours, And this matching is not conditional on investment performance. It is structural. It is built into the architecture of the account. It arrives regardless of what markets do, and this means that on day one, before the money has been invested for a single hour, you already have a return that most investments would take years to deliver, and yet people ignore this in favor of chasing last month's best-performing fund. And this is the financial equivalent of leaving cash on the table and then working overtime to earn it back somewhere else. Beyond BES, Turkish investors managing portfolios that span both TL-denominated assets and foreign currency exposure face a specific complexity that deserves real attention because currency dynamics in an emerging market context add a dimension of risk and opportunity that does not exist in the same way for purely dollar or euro-denominated portfolios, and managing this manually, making intuitive judgments about when currency exposure is too high or too low, when to hedge and when not to, when rebalancing is being driven by actual asset performance versus currency movement. This is genuinely difficult and genuinely consequential, and it is exactly the kind of continuous multivariable monitoring that systematic tools handle better than human attention. Now let us go deep into tax architecture because I want this to be the most comprehensive plain language explanation of this topic you have ever heard. Tax architecture means designing not just what you invest in, but where you hold it, when you move it, and how the legal structures available to you interact with your long-term strategy to either work for you or against you. Most people think about taxes as something that happens after the fact, as a cost that arrives at the end of the year and must be paid, and this is the most expensive way to think about taxes, because taxes are not just an outcome of investing, they are a variable that can be shaped. And shaping that variable over 30 years has a larger impact on your final outcome than almost any single investment decision you will make. Let me give you the most fundamental concept in tax architecture: the difference between tax-deferred accounts, tax-exempt accounts, and taxable accounts, and why putting the right asset in the right type of account is one of the highest leverage decisions available to any investor. A tax-deferred account, like a traditional 401k in America or a standard BES in Turkey, allows you to contribute pre-tax money, meaning you reduce your taxable income today, the money grows without being taxed along the way, and you pay taxes when you withdraw in retirement. A tax-exempt account, like a Roth IRA in America, works the opposite way. You contribute money you've already paid taxes on, it grows completely tax-free, and when you withdraw in retirement, you pay nothing, not on the growth, not on the gains, not on the compounding that has been accumulating for decades. A taxable account is simply a regular brokerage account where you invest after-tax money, pay taxes on dividends as they are received, and pay capital gains taxes when you sell. Now let me explain why the placement of assets across these account types matters so much. Imagine you hold two types of assets. The first is a high-growth equity fund that you plan to hold for 30 years and never touch until retirement. The second is a bond fund that generates regular interest income every year. If you hold the equity fund in a Roth IRA and the bond fund in a taxable account, you are making a significant mistake, because the bond fund's annual interest is being taxed every year in the taxable account, while the equity fund's 30 years of compounding growth will emerge from the Roth completely tax-free. If you flip this, holding the bond fund in the tax-advantaged account where the interest compounds without annual taxation, and holding the growth equity in the Roth, where the long-term appreciation is protected from all future taxes, you have the same assets producing a meaningfully better after-tax outcome without changing a single investment decision, without taking any additional risk, without doing anything except placing the right assets in the right containers. This is asset location strategy, and it is one of the most powerful and most neglected tools in personal finance. The sequencing of withdrawals and retirement is equally important and equally neglected. The order in which you draw down different account types during retirement determines your tax bill for potentially 20 or 30 years of retirement income, and a strategy designed in advance that sequences withdrawals to keep your annual taxable income in lower tax brackets, while allowing tax-free Roth assets to continue compounding untouched for as long as possible, can be worth hundreds of thousands of dollars over a full retirement. And this is not exotic financial engineering available only to the wealthy. It is systematic planning available to anyone who takes the time to understand it or works with someone who does. And now, brother, I want to bring everything together because I want you to leave this video not with a collection of interesting ideas, but with a single coherent picture. The system we have built across these videos has layers. The foundation layer is the portfolio itself, globally diversified, low-cost, automatically funded. The operational layer is the automation, the systematic contributions, the rebalancing protocol, the rules that run the machine without emotional interference. The intelligence layer is the monitoring, the drift detection, the tax loss harvesting, the anomaly flagging, the continuous improvement of execution quality. And the architectural layer is the tax structure, the account types, the asset location, the withdrawal sequencing, the legal frameworks that determine how much of what the machine produces you actually keep. Every layer matters. Every layer compounds. And the people who understand all four layers and implement all four layers systematically and patiently are the people who 30 years from now will have outcomes that seem impossible to everyone around them, not because they were smarter, not because they took more risk, not because they got lucky, but because they built the whole machine and then they let it run. The next video finishes the blueprint completely. Stay with me, brother.